You have spent 30 years climbing the mountain of wealth accumulation, but you're about to face the most dangerous part of the journey, the descent. Most people over 50 are still using the same growth strategies that got them here, even though a single market downturn in the first 3 years of retirement can permanently zero out a portfolio. There is a way to engineer a guaranteed floor of income that covers your lifestyle without ever touching your principal during a market crash. I'm seeing a massive shift in how high net worth families move from maybe I have enough to I know I have enough. It comes down to 5 structural shifts in your portfolio that most advisors simply aren't talking about. And the third one is a specific reason most traditional 401k plans fail during high inflation years. I'm Bart Street. I'm a CFP professional and founder of Street Wealth Management, a fiduciary financial advisory firm based in Greenville, South Carolina. I specialize in retirement income planning for physicians, business owners, and executives, people who spent decades building real wealth and want to make sure it works just as hard in retirement. Let's get into it. Shift number 1. The common approach for anyone over 50 is the classic 60-40 portfolio. You've probably been told for decades that keeping 60% in stocks and 40% in bonds is the safety net you need. It's a one-size-fits-all model that assumes the market will always balance itself out in time for your monthly distributions. This fails because of sequence of returns risk. If you retire in 2026 and the market drops 15% while you're also drawing 4% for living expenses, you aren't just down 15%, you're down 19%. Your portfolio has to work twice as hard just to get back to even, and often it never does. You're effectively selling your shares at a discount just to buy groceries. What you should do instead is implement the 3-bucket strategy. This separates your money based on when you actually need to spend it, rather than just grouping it by asset class. It creates a psychological and financial buffer that protects your long-term growth from your short-term needs. To actually do this, you'll fill bucket 1 with 2 years of cash and liquid money market funds. This is your sleep at night money. Bucket 2 holds 5 to 7 years of predictable income, often using specialized income annuities or laddered bonds. Bucket 3 is your core growth engine. When the market is up, you refill the cash buckets from your gains. When the market is down, you leave the growth alone and live off the guaranteed income you already set aside. Shift number 2. Most people treat their Social Security or pension as a standalone check that just happens to show up. They focus entirely on the date they can start collecting, usually aiming for age 62 or 67 because they want the money now. They view it as a bonus rather than a foundational piece of their investment architecture. See, this approach fails because it leaves your highest yield investment on the table. For every year you wait to claim Social Security between 62 and 70, your benefit increases by roughly 8%. There's almost no private investment in the 2026 market that offers a guaranteed inflation-adjusted 8% return with zero market risk. By claiming early, you're often forcing your private portfolio to work much harder to fill a gap you created yourself. Instead, you need to view your retirement income as a puzzle where the guaranteed pieces must be locked in first. We call this the income floor. You want your fixed costs, things like property taxes, insurance, and food, to be covered by sources that do not fluctuate with the S&P 500. How you actually execute this is by running a gap analysis. Calculate your monthly fixed expenses, subtract your Social Security. If there's a $3,000 gap, you don't just hope the stock market covers it. You look at shifting a portion of your IRA into a modern income annuity that bridges the exact $3,000 gap. This turns your portfolio from a source of stress into a tool that handles the needs so your stocks can handle the wants. If you're realizing that your current plan is just a collection of accounts rather than a cohesive strategy, let's fix that. Click the link in the description to book a strategy call with our team. We'll look at your specific numbers and help you build a floor that the market can't crack. The third major shift involves how we handle the hidden tax of inflation. Most retirees look at their total balance and think they are wealthy, but they ignore the fact that $1 million in 2026 will buy significantly less by 2036. The common approach is to just spend less as things get more expensive, which is a miserable way to spend your golden years. This fails because it ignores the rising cost of health care and long-term care, which often outpaces general inflation. If you have all your money in fixed bonds, your purchasing power is evaporating every single year. You end up in a death spiral where your expenses go up while your income remains flat, forcing you to dip into your principal faster than planned. What to do instead is build an inflation-adjusted ladder. This is the part most people miss. You don't just want income, you want income that grows. You need to identify which parts of your portfolio are designed for current income and which are designed for future purchasing power. The specific way to do this involves using products with cost of living adjustment riders or dividend growth stocks that have a history of rising payouts every year for 20 years or more. For example, rather than buying a high-yield bond, you might look at a hybrid approach where an annuity provides a base check, but a portfolio of dividend aristocrats provides the annual raises you need to keep up with the cost of living. This ensures your lifestyle in 10 years looks exactly like it does today. Shift number 4. Many people over 50 are terrified of annuities because of the high fees and loss of control associated with old products from 20 years ago. They avoid them entirely, preferring to stay 100% in the market. They think flexibility is the same thing as security, but in retirement they're often opposites. This fails because it leaves you vulnerable to the 4% rule breaking down. In a low interest rate or high volatility environment, the 4% rule has been shown in many recent studies to be closer to 2.8 or 3% to be truly safe. If you keep all your money in the market to maintain control, you might actually be able to spend less money than if you had secured a guaranteed payout. The better move is to use instructional capital. This means you're giving a specific job to every dollar. Some dollars are for growth, some are for legacy, but a specific portion should be income capital. This is where a modern income annuity fits. It isn't an investment you check every day, it's an insurance policy against outliving your money. To do this right, you don't move your whole portfolio. You might only move 20 or 30%. By doing this, you actually give yourself permission to be more aggressive with the remaining 70% because you know you have your daily bread. It's a mathematical paradox. By locking up some money in a guaranteed income stream, you often end up with a higher total net worth because you never have to sell your stocks during a crash. Planning for 30 years of income is a massive mathematical task that you shouldn't do alone. If you want a professional second opinion on your transition from accumulation to distribution, click the link below. We can help you determine the exact percentage of your assets that should be protected. Now, the final mistake is ignoring the tax map of your retirement. Most people have the bulk of their money in a traditional 401k or IRA. They think of that number as their money. They get to 59 or 60, start taking distributions, and are shocked to find that the IRS is their largest beneficiary. This fails because it ignores the reality of required minimum distributions, or RMDs. By the time you hit your mid-70s, the government forces you to take money out of those accounts, often pushing you into a higher tax bracket and causing your Social Security to be taxed at a higher rate. It is a massive tax trap that closes just as you're trying to enjoy your retirement. Instead, you must start tax bracketing your income now. This involves moving money from forever taxed accounts to never taxed or tax advantaged accounts while you still have the time to do it. Now, how you actually do this is through a series of partial Roth conversions or by using the tax treatment of certain insurance products. For instance, if you use non-qualified funds to purchase an income annuity, a large portion of each check is considered a return of principal and isn't taxed as ordinary income. This lowers your provisional income, which can keep your Social Security checks tax-free. It's about how much you keep, not just how much you make. If you're over 50 and realize your current advisor is still playing the growth game while you're ready for the income game, it is time for a different conversation. Managing a portfolio for income requires a completely different set of tools than managing for growth. We specialize in helping families design an exit strategy from the workforce that provides certainty, tax efficiency, and a permanent floor of income. Click the link in the description to schedule your strategy call with Street Wealth Management. We will sit down, walk through your specific assets, and show you exactly how to bridge the gap between where you are and the retirement you deserve. Let's make sure the next 30 years are your best 30 years.